Hello everyone, welcome to Dickson's Financial Accounting 101 Tutorial 1. And today I'm going to teach you the basic principles of debits and credits. First of all, I would like to give you the definition of a debit and then a credit. Debit is an accounting entry that either increases an asset or an expense account, or decreases a liability or equity account. It is positioned to the left of an accounting entry. So this is my left, so your left is here. Whereas a credit is an accounting entry that either increases a liability or equity account or decreases an asset or expense account. It is positioned to the right of an accounting entry. So the right is here, this one, which is my left. So for my accounting classes, I memorize the specific categories. So I always think AED on my right, and I know that that's my debit. And then I always remember CRL, and which is credit. So A stands for assets, E stands for expenses, and D stands for drawing. And drawing is beyond the scope of the course, but is principally saying if an owner or someone in the company wants to draw money from the company for their personal use. But in my tutorials, I will mainly focus on assets and expenses. And assets can be split into two categories. We have the short-term assets or the long-term assets. And short-term assets are like cash and mostly all the liquid assets that can be converted into cash within the first year. And within the first year, it is the first 12 months. And for expenses, it's all the company expenses, electricity bill, administration bill, distributed expenses, all these are expenses. So when you want to increase the company's expenses, you always have to put it into a debit account. Okay, so here's my little definition of the AEDs. Just memorize an AED. It's very simple, just 3 letters AED. And then for the credit, you would like to memorize CRL. This is going to make your life a lot easier. And capital also categorized in the category of equity. As we can see from this definition, a credit is an account entry that either increases a liability or equity account. So I just put C, which stands for capital. But this also means equity, okay? EQUITY. And if you want to increase the company's revenue, you always put it in the credit account. Credit account is a revenue account. So I put revenue, and a lot of my students' questions, they have income. So I'm just going to put income here as well. And lastly, we have the liabilities. And liabilities also can be considered into current or non-current liabilities. So maybe I should put it here, current and non-current. So you'll know what I mean when it's non-current. And non-currents are usually plant, property, and equipment. These are large assets such as land and buildings are non-current because they are within the balance sheet of more than a year. But I'll give you more definitions in my other tutorials, but I just want to give you the basics of what differentiates a debit or a credit. So a liability is a credit account. And that can be also current and non-current. Here is a quick example to portray the debit and credit. Why do we have debit and credit? The main reason is that we have double entry accounting. The debit column must equal to the credit column to show the true and fair view of a financial statement. 9,200 of assets is already done. And you can see assets is A. So we want to put it into the debit column. So I'm just going to put 9,200 200 here. And we'll put an assets. And then the second one, we have 3,400 of liabilities. And where does liability go? Liabilities goes into the credit column. So we're just going to put it into credit column. So liabilities, credit column. Oops, not put credit, put the number there. Good. And 2,500 are retained earnings. So these are earnings that are retained, and retained earnings goes into equity. So when they go to equity, we can see equity here, it goes to credit. So we'll just go retained earnings. Good. So I'm just going to put the number here. So it's 2,500. So we would usually add these all up. So we can go total. And we usually put an underline to show these are the total for all those. I'm actually put this number here so it can be read easier. I'm going to put an underline here as well to show the total. So we have the total of debit of 9,200 and then the credit of 5,900. You can just put this in the calculator. Good. As you can see, the debit is 9,000 and credit is 5,900. Does this fit within the definition of double entry accounting? Like I said before, they have to equal to each other. Common stock is in credit because we want to find X. So simply we just have to go 9,200 minus 5,900, which is equal to 3,300. So common stock is therefore 3,300. So I hope you guys memorize the AED for debit, CRL for credit, and making sure that the debit equals to the credit. So give this a try, and I hope you like this tutorial. Thank you.